And when that event happens, you won't need Rick Rule to tell you. We won't be talking about a move from $36 to $38. We'll be talking about a much more dramatic move. And I have a lot of confidence that will occur. Silver is probably the place, the asset class, that the speculative precious metals adherent should be participating in. I've been through 3 precious metals bull markets in my life, and they follow very predictable patterns. The gold, physical gold leads because the fear buyers first. When the momentum is established, leadership changes from gold to the senior gold stocks, and we've just seen that. At some point in time, the momentum in the precious metals price verifies the precious metals narrative to generalist investors, and the generalist investor comes into the market. When that happens, leadership changes from gold to silver. I'm not sure why it does. I suspect it's because of the lower unit cost, or perhaps the reputation for upside volatility. I don't know that it does, but I've observed that it does. And when that event happens, you won't need Rick Rule to tell you. We won't be talking about a move from $36 to $38. We'll be talking about a much more dramatic move. And I have a lot of confidence that will occur. I have no idea when. And the truth is, I've stopped caring when, because the moves are so dramatic that the rent your portfolio gets paid on its silver holdings justify the time that you spent waiting for it to occur. The very small population of viable silver companies does even better, because the consolidated market cap of that sort of silo of reasonable quality silver equities is so small that when the generalist investor tries to crowd into it, the market caps simply can't contain the money. In my first bull market in the 70s, watched Coeur d'Alene mines go from 10 cents to $65. I was too young, too dumb, too poor to participate. But the second precious metals bull market I was prepared for. We had 2 horses in that race, Silver Standard, which went from 72 cents to $45, and Pan American, which went from 50 cents to $45. They were extremely pleasant events for a young man. And I'm hoping to repeat that sort of fortune, maybe not with the same percentage gains, but I'm hoping to repeat that fortune, that sort of circumstance in this market. And I'm fairly confident that that will occur. And I've watched the last 3 markets, and none of them had anything to do with the industrial side. The truth is that gold does well when people are afraid. And that's usually, in terms of the broad economy, a counter indicator. It has been, in terms of its dramatic moves, always a monetary phenomenon. It's useful to the monetary case that the industrial case exists because some silver is destroyed in industrial processes. It's supply that goes to supply heaven. You know, damn near all the gold that's ever been mined, we do a weird thing. We take it out of a hole in the ground called a mine. We put it in a hole in the ground called a vault. But we actually use silver. Some silver goes to silver heaven. You know, it gets destroyed as a germicide, or it gets used in a solar panel. It doesn't get recycled or something like that. And so you have circumstances where the industrial utilization of silver exceeds the amount of silver newly produced in the market, either via direct mine production or co-product production or recycling. We're in the midst of one of those periods today. But in my experience, not going back to the beginning of time, but going back 50 years, the real dramatic increases in the silver price are always monetary. I have no idea. I mean, I honestly don't. I know that makes a bad headline. You know, when people talk about the former all-time high price in silver and they quote $50, that's a huge mistake because that's assuming constant dollars. You need to talk nominal dollars. My suspicion is that if you inflation adjusted that $50 number, you'd come out with a number closer to 150. I think people make a mistake with the headline prices that they assign silver. I don't like to do that anymore. I don't like to get people too excited. If you give people some number, they ignore the rest of the interview and focus on the number. And I think that's a mistake. I think people need to familiarize themselves with the entirety of the subject of gold and the entirety of the subject of silver. If you give them a number to cling on, they forget the why. And they can easily get shaken out of a good position that they should hold. Claudia used a good word, talk. A Bitcoin reserve. What kind of reserve? In the United States, I can't speak to Great Britain, but in the United States, our on-balance sheet liabilities exceed $37 trillion, or $30 trillion net of the Fed's own balance sheet, 30 trillion net on balance sheet debt. But the off-balance sheet liabilities, according to the Congressional Budget Office, exceed $100 trillion. Now, interestingly, the Internal Revenue Service, similar to your inland revenue, estimates that the private net worth of Americans, assets minus liabilities, is $141 trillion. So let's look at the reserve math. Collectively, we're worth $141 trillion. And just at the federal level, we owe $130 trillion. That 130 trillion that we owe is growing by 2 trillion a year on balance sheet and another $2 trillion a year off balance sheet. So what reserve? We're $130 trillion upside down. The reserve, if it exists, means that they are printing specious currency units and using them to buy Bitcoin, if that exists. It's not a reserve. It isn't the creation of wealth. It's the creation of a distortion. As to the potential competition for investor interest between Bitcoin and gold, that's a very interesting question. It's worthy to note that the market share of either asset class is less than 1% of total savings and investment assets worldwide. So the relevance of each to the global financial situation is akin to the relevance of a pimple on an elephant's behind. They don't matter. They may matter to each other, but I suspect there's plenty of room for both. I suspect myself, people are attracted to Bitcoin because of its price escalation. People who look at its utility probably think of it more as an anonymous medium of exchange, which is very attractive, to be honest. Gold is also potentially an anonymous medium of exchange, but it's much, much, much less utilitarian. You can get Bitcoin across a border in a cell phone. Getting gold across a border is a bit more challenging. So I think that's a much more interesting question. I don't see a backed currency simply because the history of governments has been, unless they owe the money to somebody more powerful than themselves, they don't pay. Why would you as a politician subject yourself to discipline when you ran on the specific promise to be undisciplined? And why, too, would you constrain yourself to creditors when you have guns and they don't? When I was young, I invested in any asset class that was amusing to me, and I got spanked for that. Now, I invest in industries that I think I understand and where I think I have a competitive edge against most participants. So I invest in natural resources, the whole range of natural resources, and I invest in conventional financial services. Not fintech, nothing like that, but, insurance, community banking, wealth managers, asset managers. I've been involved in both of those businesses for 50 years. I'm not a technology guy. I understand the basics of cryptocurrency. I've invested a fair amount in technologies around trading commodities, including gold and the blockchain, but I wouldn't describe myself as knowledgeable enough to own Bitcoin, so I don't. In the very, very near term, I think the stock market's in okay shape, simply because there's so much liquidity. The investors I know, the family offices that used to be my clients, are awash in cash and looking for ideas. Real concern in the near term, as expressed by the VIX, is nil. This is not a market, an equities market, that people are afraid in. There are some people like Buffett who are opportunity constrained. Buffett is famous for saying that the market isn't a topic. It's merely a facility to buy and sell fractional shares in good businesses. And I think he's had a rough time the last year and a half finding businesses that were selling at prices that he felt like he could pay. It may also be that he's making a market call. He's famous for talking about the difference between the market capitalization, the S&P 500, and the GDP of the United States. And by that metric, the markets are horrifically, according to him, overpriced. My own constraints are really that, as I say, I sold a developed real estate portfolio because I thought with interest rates rising that the wind was no longer in my sails, and I haven't been effective at redeploying it yet. My portfolio's done fine because I happen to, buy the kind of stocks that have performed extremely well in the last 3 years. As for Mr. Dalio, he's an absolutely superb speculator, and you need to pay attention to what he says. But I don't think the early movers like Dalio and Druckenmiller are reflective of the equity markets in the next few months at all, simply as a consequence of the fact that there's way too much cash and there's way too much confidence. One other note on that, there's a lot of political pressure in the United States to lower the interest rate, despite the fact that, according to the politicians, our economy is in very good shape, and despite the fact that even their fraudulent index of inflation is in dangerous territory. If they were to lower the interest rate meaningfully, or if they were to make several small rate cuts, I think savers and investors around the world would say American society's resolve to defend whatever integrity is left in the US dollar has been abandoned. And then I think you'd see the anti-dollar trade, including gold, get very, very strong. I saw that at the end of 1975. You won't recall because you were probably unborn, yes. But read a lot. I mean, a lot. Don't take my word for anything. Use everything I've said as a suggestion that you should study more. Remember that your biggest investment risk isn't in Washington or London. It's conveniently located to the left of your right ear and to the right of your left ear. Remember, too, that your time preference doesn't matter to markets. You may want something to occur in 6 months, but 5 years is a much more realistic time frame. And in addition to being patient, you have to be persistent and tenacious. My really big speculative stock wins, 10 baggers, 20 baggers, 30 baggers, have all taken 5 or 6 years to unfold. And they have all exposed me to 50% share price declines during the period of time I owned them. So, in addition to being patient, I had to know enough about the investments that I didn't get shaken out by some pretty ugly price declines. So that isn't the kind of advice a young person wants, is a 10-cent stock that's going to go to 30 cents before their birthday. I don't do that stuff. You got to invest in yourself. You got to invest in your reputation. You got to invest in your knowledge. And you know what? You got to save. You cannot be solvent if you aren't a capitalist. And you can't be a capitalist if you don't have capital. And you can't get capital if you don't save. So a minimum of 10% of pre-tax income, no matter what. I don't care if you have a fancy night out or drink Starbucks after you've saved 10% pre-tax.